Welcome to Getting Real with Real Estate with Danielle Kempf and Jim Kempf, St. Louis's favorite father-daughter real estate team. Your source of real estate information in the greater St. Louis area.
All right, guys. Well, here we are.
Hello.
Hello. Thanks for joining the podcast today. Danielle, you want to start us off with a little
With
joke
our joke?
today? Yeah.
Our joke of the day. Okay. Why couldn't SpongeBob get a mortgage?
Oh, man.
Do you know?
No, I don't know that one. I don't know that one.
Because his house was underwater.
No, that would be good. That would be good.
All right. So, good joke there, Danielle.
Thank you.
All right. So, we on a previous podcast, we talked a little bit about financing 101.
Yep.
And today,
Just went over all the different types of loans out there.
Yeah, absolutely. And today, we're honored to have Mr. Micah Mayfield with Delmar Mortgage here with us. Thank you for coming, Micah. Micah's our guinea pig. He's our first guest on the show, so we're
Yes.
happy about that. So today we're going to kind of talk a little bit more about the conventional loans, right? To kind of give people a little idea of how that process works and what you can expect.
Yes.
But maybe to start off, Micah, you want to talk a little bit about yourself and your background real quick?
Thank you. So my name is Micah Mayfield. Been at Delmar Mortgage for 7 years.
Nice.
And just have a passion for helping families, put the best loan strategy in place that, doesn't necessarily, hamper the rest of their financial plan.
Right.
Personally, I got a couple kids. They're active in everything I can sign them up for.
Nice.
That's
And you're a coach, I know, right?
yeah.
Coaching some sports?
Yeah. So
Nice.
that comes risk and reward to make sure
Yeah.
I don't look a fool out there, and then people know what I do professionally. That wouldn't be a good match.
Right.
So but I love helping those kids, and in fact, just the other day, one asked, like, "Are you going to coach the next sport?" And it happens to be soccer, and I'm awful at it. So, so I won't be, but that's kind of rewarding when the kid likes the sport I'm doing enough to say, "Are you going to coach the next one?" So
Yeah.
that
That's
right
awesome.
there is pretty awesome.
That's cool.
awesome. Yeah. When I
You
coached
coached
Danielle's
volleyball.
she hated me.
I did not like him as a coach.
Well, it wasn't my kid who asked me that. Let's just say that.
All right. Well, we digress. So let's get back on track, right?
Okay.
Let's talk about conventional loans.
Let's talk about
You want to
conventional
fire out, ask Micah the first kind of question we had for him?
So, Micah, what is your ideal customer for a conventional loan?
Good question. So I think traditionally folks have thought of conventional loans as I shouldn't even bother until I have 20% down.
Yep.
That's kind of just been the thought that their parents told them probably when they bought a house.
Yep.
But the ideal conventional customer is your regular folks. Regular folks who have avoided any hiccups in their background, so they pay their bills. They might have a couple of mistakes here and there with a missed credit card payment, but they got caught back up. Conventional loans are for the average person.
Okay.
And then, and if you can put somewhere between 3 and 5% down, that's a good place to start.
Yeah.
And then we'll talk about the pros and cons with that family after that.
Very cool.
Okay.
Cool. So let's talk a little bit about the kind of the basic qualifications. And I know, like, the loans have to qualify under certain guidelines from Freddie Mac and Fannie Mae, right?
Yes.
Is that kind of correct? Talk a little bit about that for us.
Yeah, so that's kind of the hidden, when it's called conventional, a good way to think of it is the banks you drive by on a daily basis, when you add up all the money they have together in all their branches, they do not have enough money to make the mortgage market work.
Right.
Okay, it will not, because the mortgage dollars are so large and they move around so much. There has to be another place behind them where they get their money.
Right.
And Fannie and Freddie Mae, Freddie Mac, eventually buy all the mortgages that those banks make. I say all, but it's almost all.
Okay.
So with that, they set some guidelines, and their guidelines are maximum debt to income. So maximum debt to income, the easy math behind that is your money you make before taxes. Before taxes, remember that.
Okay, that's important. Yeah.
Your total debt can't go past 45% of that. Okay. That would make you very house poor, but I could still qualify that person.
Right.
So we would need to have a bigger conversation of whether that made sense. But
Yeah.
That's the biggest guideline that really, that's where you should start thinking. And then they have minimum credit score standards. So 620 is your minimum where we should even be talking about conventional.
Okay.
And then then it's loan to value, that percentage down. Okay, when you think 20% down, that's 80% loan to value.
Right.
Yep.
Okay, so 5% down is 95% loan to value. So those are your three big kind of like legs to the stool when it comes to conventional financing is, do you have too much debt?
Right.
Is your credit score too low? And are you borrowing too much?
Okay.
And conversely, the positives of those.
I love that you said not making sure they're not house poor.
Yeah.
Oh, for sure.
Because we work with a lot of our share of first-time home buyers and stuff, right? And that's the one thing that a lot of times they talk about too, and we kind of try to talk about that with them a little bit, right?
Mm-hmm.
Because you don't want to be so strapped out
For sure.
on a house that you can't live life, right?
Exactly.
So that's important. That's
Well, and if I can reiterate the debt to income there, that 45% exists not for two working people. That's every dollar they make, and then when you add all their debts together, they're barely affording that house. Maybe we're working with just one borrower who is a W-2 employee, and maybe the spouse is self-employed and they have lumpy income, right? Well, rather than looking at both incomes, which are going to be very confusing, let's just go with the one borrower, and maybe we approve that person at 44%. In reality, they're not a house poor family, right?
Yeah.
But we're using the guidelines in place, and I think a lot of that Fannie and Freddie guidelines are in place to say, like, okay, let's look at what's the approvable part, and we need to trust the mortgage lenders out there, like me. Hopefully, there's some trustworthy ones as well, right? To make good decisions to say, like, 44% works for this family because we're ignoring Joe's income because his wife has a W-2 job and he's self-employed and he maybe only has one big sale a year.
Right.
Right.
But there's money coming in.
Exactly.
Right.
We've
That's
seen
awesome.
it, but we're just not going to use it to underwrite.
Yeah. That's awesome. That makes perfect sense. Cool. All right.
And then as you're talking to like those couples, like those two different couples, what is like the typical loan application process for them?
Sure, and technology can make things easy and hard at the same time.
Understood.
Right? So, my team's specific approach is a phone call first, right? You can not only get the application done in a 15-minute phone call, but you can talk about the hurdles in the process as well.
Oh, okay.
If I send them a link to apply, that's like if a tailor said, tell me what suit you want and how you want it to fit.
Right.
Well, no, that's their job, right?
Right.
You go in, you get measured. Well, that's kind of the same idea when it comes to our application process is I can send you a link if just our schedules don't conflict or are conflicting, and you need to do it after hours or it's the only time I see electronic applications is the 2 a.m. ones. That's the one I'm not available.
Right, yeah.
But
people send us houses to see it.
Exactly.
Like 4 a.m. too. Right?
Yeah, and that's the digital side. And I think otherwise, if it's a time when most people are awake, let's do a phone call.
Yeah.
And
I love that.
so then once we do the phone call, and as we're talking, I can be doing the numbers with them live.
Right.
And I could say, like, here's where your debt to income lands if you have a decent idea of your debts. Here's if your income if you know it. Do you kind of know your credit score? Here's where you'd be. Okay? Let's talk about your goals and then let's apply. Okay? The application then is the credit pull. Right? And that's where we start. Yeah. And I want to encourage everybody to apply because I want people to know their ability to do the thing. But let's talk what the process is going to look like in the conversation.
It's nice to have those conversations up front. Relating that to our business, we do the same thing when someone wants to sell their house, right? It all starts with a phone call.
Yeah.
Sure.
Right. So, and me being a little old school, we've talked about that a few times, right?
Have.
But that phone call is important, right? You're building that relationship with somebody, you're building rapport with them, and I think that just makes your transaction overall much smoother.
Well, I'm not going to get that phone call if I can't tell them the value, just like you said.
Yeah, right.
Like you're telling them the value why the phone call is important.
Right.
Sometimes I have to sell the phone call.
Yeah.
Okay,
Yeah, right,
but that's okay. Like, well, let's text before to figure out what you want.
Yeah.
Okay, and your timing and stuff, and then let's get on the phone.
Yeah.
I think they'll make it easier.
Yeah, cool. Okay. Well, we talked a little about the down payment requirement. I think we found NAR, right? We did some stats on that one time. Average, like around the country, is about 7% down, something.
Okay.
In that
6 or
range.
7,
So,
I think it was.
So yeah, I think folks just need to know, right? That, and you just mentioned it. They don't have to have that 20% down.
Sure.
Which is important because that kind of scares the bejesus out of some folks.
That's a lot of money.
Right? That's a lot of money.
Yeah.
It is.
Yeah.
It would slow down the housing market to a halt if that was the
100%.
case.
Yeah.
There is a very famous person that I will not name that will refuse to give the advice of ever paying mortgage insurance. Okay, so mortgage insurance is what you have to pay on a monthly basis if you don't have 20% down.
Right.
What's shocking is how cheap mortgage insurance is once you start to not be so risky. Okay, so if your credit score's above 680, you're already going to get cheaper mortgage insurance.
Right.
If you put 7 to 10% down, you're already going to get much cheaper mortgage insurance than the 5 or 3% down folks. If you put 15% down, you might actually get a better interest rate than if you put 20% down.
Right.
Because a part of your mortgage is insured.
Yeah.
So those are the things that matter. Who cares what the rate is if your payment makes sense?
Right.
You know, if it's the right payment that supports your goals and it's affordable, that should be your end all goal.
There's a lot of moving pieces there, obviously.
For sure.
Yeah, I mean,
For sure.
definitely to get somebody in exactly the right mortgage that works best for them. And that's what I hear you saying is you're working with them on an individual basis. It's not just like a cookie cutter, right?
Shouldn't be.
One client, everybody gets the same mortgage. It's what works best for the individual, right? That's what's important, I think.
Agreed.
Yeah, cool. What else? PMI, we talked a little bit about PNI.
Well,
I think Micah talked about that.
I can expand on it a little bit more because when it's an insurance policy that you buy and you don't get a benefit of.
Right.
Like every other insurance you buy in the world, it covers something that you own.
Yeah. This protects the bank, right, essentially?
This just protects the bank.
Right.
And you're forced to pay it because that's the only way this works, right? And that's okay.
It's the rule.
Right, and you can buy it in a ton of different ways. You can pay for it every month until you have 20% down. You can buy it out in one chunk at the beginning. You could pick an interest rate high enough where I can buy it out for you. Okay, so there's tons of ways we can essentially pull a lever. Remember, if you pull a lever, the other side goes up or down, right? So we got to figure out the give and take of that.
Yeah, right.
You can even break it in half where you buy a chunk and then that reduces your monthly obligation. So maybe you're cash rich right now, but income low, or income high, but cash low.
Right.
So we can figure that out.
That's awesome.
Okay.
Yeah, that's cool. Okay. You want to talk about seller concessions?
Concessions?
Yeah, we don't see a lot of seller concessions.
Not in today's market,
We-
but it might come back.
Right. So as far as closing cost credits, those kind of things, are there maximums that we need to be careful of, right, for clients?
Yeah, there are. And seller concessions can cover any closing cost. And I think the first best way to describe that is to describe what a closing cost is. It's not just the fee that I charge. It's not just the title company's fees, but it's any of the costs that you have to expend to get to the closing table. So,
Got some insurance in there, right? Some appraisal.
yep. So, if you have to prepay some escrows on your taxes, those are all closing costs, legally described closing costs. So the seller concessions can pay any of those.
Okay.
So in your conventional seller paid closing costs, you can get more. Let's stick with the conventional because it's probably the most complicated and the most germane to what we're doing.
Yeah.
The more you put down, the more the sellers can pay, right? Because it doesn't look like they're incentivizing you to buy, and we want to make sure we're protecting our borrower, that they're not being tricked into buying,
Right. Sure.
So if you put as little down as possible, you can, so anything less than 10% down, the seller can pay 3% of the loan amount.
Okay.
Okay. If you put 25 to 10% down, they can pay 6%, and over 25%, they can pay 9%.
Oh, so it's tiered. I didn't realize
Yep.
that.
Yep.
Okay.
And most of what we see is the 6 is the max and
Yeah.
6 is a lot.
Right.
Okay.
That's a lot. Yeah.
And
it
at
is.
some point, 9% is more than any closing costs we're going to see in most markets, right? Because you don't have lawyers' fees in most markets. You just have title fees. So, in our market here, we have some of the lower fees in the country.
Okay.
So when you start looking at the maximums, you may never get there on most transactions.
Right. Yeah, because you see deals around the country, right? You guys are licensed in more than just Missouri.
37 states.
37 states.
I'm licensed in about 10 or 11. I can't remember exactly. Each one's a little bit extra test and application fee, but
Yeah.
I tend to be licensed in the states I've worked with before. Or I have a referral partner there.
Yeah.
Speaking of closing costs, I just closed one in Georgia, and they got max closing cost concessions on a VA, and we had to find all of them, right?
Wow.
So they got 12 grand, which was
Wow.
right there. So with a VA, there were some additional fees that we can move into different columns so that they could take advantage of that. And the realtors were super helpful in that. It was good. It was good to have everybody on the same page.
Yeah.
The seller wanted to do the deal. Both realtors wanted to make sure that the buyer got what they could.
Wow.
That's important too,
Yeah.
believe it or
Yes.
not. We
Oh,
see those
sure.
times, right? And you
Oh,
probably
sure.
see a little of that too. But I mean, we get to, sometimes agents want to butt heads with each other. I don't
Yeah.
understand it myself. I like to work with the other side.
Yeah.
We try to, of course.
Try to.
But, it's all in the best interest of the client.
For
is
sure.
what we try to do.
Let's hope.
So, and then I guess maybe speak toward. I mean, we kind of talked about that in our first podcast, just to try to let people know, hey, what can I expect in terms of what documents do I got to provide, all that stuff. So once I get under contract, what do you need to from that client to get them to the finish line? If you will?
So let's hope that we started with the truth. Right? My
a
job
big
is to
one,
ask
yeah.
the questions, and the client's job is to tell the truth. So once we've gone under contract, that's when we underwrite the file. Now we can pre-underwrite. I think we may grab on that later, but
Yeah.
let's say the traditional way of they spoke to me, I did the application, I gave them a pre-approval, pre-qualification. You can afford this. When they go under contract, now we need to prove up 3 things. That's all: credit, income, assets.
Gotcha.
Okay. Now that doesn't need me 3 pieces of paper. Okay. We need to prove that with a credit report, which I've already pulled. With the income, we need to show it's stable and reliable. So we need to show: did you make money? Are you making money? And will you make money? Okay. So if you think about that as, did you make money? Tax returns. Are you making money? Pay stubs.
Yeah.
Will you make money? Are you a contractor or an employee? Right.
right.
Are you? Have you already put in your notice? Have you already told them you're going to retire? Right. So if those things are in the future, and your employer is employers aware of those things, they're going to cause
They're
trouble.
gonna tell you that, right? Yeah.
So again,
Right.
tell the truth.
Yeah.
Support the truth of documents. And then assets. Were they yours to begin with? And are they sitting in a place where it makes sense? Like, are they in a bank? Are they in your retirement account? Are they with your financial advisor?
Not under your bed.
Look, I've seen pictures of stacks of silver.
Yeah.
Okay.
Yeah.
At some point, you have to prove to me that they are stable assets.
Right.
And so after you go under contract and we're underwriting you, don't move them around. Okay.
Right.
Yeah.
That's another concern of, are they where they say they were, and don't mess with them.
Right.
Okay. There are plenty of opportunities for people to help you with your down payment that it isn't your money, and that's fine. We call those gifts, right?
Okay. Yeah.
So if it's a family member or a close relation, and they want to give you some money for down payment, that's fine. If they agree to it and you're going to do it and you tell me about it, don't do it until I tell you to do it, right?
Yeah.
Right. So I'll tell you the day you need to do it all,
Okay.
and that'll be in between contract and close.
Gotcha. Okay. Awesome.
Yep.
So talk about you mentioned pre-underwriting,
Sure.
and we kind of skipped over that earlier, I think. But that in this market is a great service that you guys provide and helps our buyers because
It's a good tool.
oh, it's a great tool. Talk a little bit about doing that for us, if you would.
Perfect. And I think best way to describe that is a little bit of history lesson. So, a couple decades ago, houses were bought over the weekend, and then the person who got the accepted contract sat at the phone and called 7 banks.
Right.
Okay?
Right, yeah.
Like, I bought a house. I need to find
Yeah,
money.
yeah,
right?
right. Yeah.
Okay, so now, after that, pre-qualification came. Pre-qualification was, you called me, you told me what you did, you got your credit pulled,
Right.
and I built a letter that says, I believe this person based on their credit score and what they told me,
Right.
they can buy a house.
Right.
That was called pre-qualification. Now, more recently, pre-qualification now is more like this lender identified you as a possible buyer, so they'll send you a letter in the mail that says you're pre-qualified for up to this amount.
Right.
They're not pulling your credit. They're not looking at anything.
Yeah.
So we replaced that word in the industry with pre-approval.
Yeah.
Pre-approval is you talk to me, I pull your credit, you send me some documents to review, and I will say, based on this is consistent with what I see a loan get done, and I upgrade you to a pre-approval letter. In a competitive market, and we saw this in 20 and 21, cash was the only way houses were transacted.
That's exactly right.
Okay?
Yeah.
And that, remember when I said there's not enough cash in the banks?
Yeah.
The mortgage market's going to, the real estate market will just grind to a halt. That'll happen if cash is the only way houses are bought.
Right.
Okay? People need to borrow to get a house.
Sure. Sure.
So what we've done in the reaction is, as at Delmar, we will take your file. Not only me will look at it, but our underwriting team that's in-house at Delmar here in the area, they will review it and put it through full underwriting. They'll run it against Fannie and Freddie guidelines, and they will issue a loan commitment letter before you even make an offer on a house.
Yeah.
It costs nothing. It just costs us money.
Yeah,
Right?
yeah, that takes a little. Well, it's not.
Yeah.
It's a little bit of risk. It's
Sure.
it's you're investing time
Yep.
into that client, right?
Yep. So we use some of our expense to make
Yeah.
sure that we can make our client more competitive.
Yeah.
We call it fast track pre-approval internally. We market it as that.
Yeah.
It's a loan commitment. Okay.
Yeah.
There's only 3 things left after that letter that could go awry: appraisal,
Yep.
insurability. So is it a flood zone? Is it a house that can even be insured? Is it a log cabin? That might not work. Right.
Right.
And then transfer of title. So can the person selling this house actually transfer you
Right.
this property when it closes? Well, those aren't my buyer's fault. Right.
Yeah. Right. Right.
So at that point, my loan committed borrower is as good as cash.
Yeah.
Okay, because the cash borrower is still going to have to worry about title.
Sure.
The cash borrower is
They
still
still
going to worry
gotta
about
get insurance.
insurability.
Sure.
And as far as appraisal, a smart buyer is going to make sure it's worth it.
That's
Yeah.
right.
Okay.
100%.
A not so smart one who hates money is just going to buy that anyway, right? So that should make my client look as attractive as a cash buyer.
Yeah.
And our loan commitment letters say so.
Right.
And then we put the stamp on there that we fully underwrote this already.
Yeah, well, that's awesome. Yeah, from a buyer's agent's perspective, right?
Yeah.
That's huge.
It is huge.
I mean, because it sets us apart.
It sets you apart, and it shows that your client has already taken those steps to verify their loan,
Right.
that they are ready to buy the house.
Yeah, that's right. Yeah, that can make or break it because the
It
market
can.
still is so competitive.
It
as
is,
you know,
yeah.
that it's
Any
just,
little bit helps,
right,
really.
for sure.
Mm-hmm.
Right on. All right,
Good
cool,
question.
cool. All right. What other questions? Any other topics that we missed there, Mikey, that you can think of?
I don't think so. I think
about?
there's plenty of other loan options out there, and Delmar can do them as well as far as FHA and VA. VA loans are still the best benefit going in loans.
Right.
So if you know a veteran,
Veterans, yeah.
that loan product is as low of a rate as FHA, which is usually lower than conventional, with no monthly mortgage insurance and up to 100% financing.
Gotcha.
That's awesome.
So that's a fantastic benefit. There's plenty of silly things being written out there about it's an expensive way to borrow. Probably the best thing I would want to leave you with is rate can be whatever you want. Okay, you can buy any rate that makes you feel good. Okay,
yeah.
but the APR we can't fudge.
Right.
Okay, the annual percentage rate has to be calculated the same way by every lender.
Yeah.
So, just as a PSA out there, for any single person who somebody's telling you that they're going to get you your mortgage that looks like X, make sure that they find out what the APR is.
Yeah, if it sounds too good to be true, it usually is.
Yes.
Right?
Yeah, somebody's
That's-
hiding the cash somewhere.
Somebody,
Exactly.
yeah,
Yeah.
you always got to know that because, I've seen it. I've had clients experience it.
Oh, yeah.
That online rate was, and they thought they were getting such a great deal, and then closing day rolls around and there's fees out the wazoo.
Sure.
Right. So, yeah, so that's great. So, I guess the moral of the story there, folks, is when you're ready to start shopping for that house.
Or even if you're just thinking about it.
Yeah, if you're just thinking about it, we'd love to just chat with you and help you get ready to do that, right? Because there's a lot. There's a lot to that process, and obviously Micah and the team over at Delmar can really help you in that process. So we want you to make sure you're talking to somebody who's going to tell you the straight up and tell you the way it is. And we can vouch for Mike 100%. He's always done that for all of our clients.
Yeah.
So, absolutely. Well, I think we'll wrap it up, yeah?
Yeah.
All good?
I appreciate you coming
thank
on
you
in.
so
and
much.
being our
Thank you
first
so much for
guest.
having us,
No,
man.
my
I hope
pleasure
it
to be
wasn't-
here.
Hope it wasn't too scary or anything.
You guys are great. Thanks.
All right, thank
You've been listening to Getting Real with Real Estate with the Kempf team. Have questions about real estate or something you'd like to discuss? Contact the Kempf team at 314-336-1926 or visit our Facebook page at facebook.com/the Kempf team. Don't want to miss any episodes? Follow us on your favorite podcast app or YouTube. The Kempf team. Real, honest real estate.